Welcome, listeners, to our latest deep dive into financial reports. Today, we're tackling the second quarter 2025 earnings call for Icahn Enterprises LP. Definitely a company that keeps us on our toes.
Always something interesting going on there, that's for sure.
Absolutely. Our mission today really is to cut through the noise, find the core insights, and give you the actionable understanding you need from this call.
Exactly. We'll be focusing on, their strategic shifts, asset valuations, and how specific segments are developing, especially in this market, which is always sort of reevaluating these diversified companies.
Right. So let's get straight to the headline numbers. Icahn Enterprises reported a GAAP EPS miss, came in at negative 0.30 cents versus a consensus of positive 0.15 cents. So that's $1.45 miss.
Yeah.
And revenue also came in a bit light, $2.14 billion, missing the $2.4 billion consensus. That's almost 11% below.
Okay, so those top-line figures might seem a bit concerning at first glance.
Right.
But it's really crucial to look deeper here. Yes, revenue missed, but it still grew 18% year over year. That's pretty significant growth.
Yeah. Okay, 18% growth, fair point.
And maybe more importantly, Adjusted EBITDA. The loss there was much narrower, only $43 million, which is, a huge improvement from the $155 million loss last year.
A big improvement, okay. And here's where it gets really interesting, I think. The company reported an indicative net asset value, the NAV increase, up $252 million just in the quarter.
Yeah, and that was largely driven, as you hinted, by CVR Energy.
Yeah.
Their shares rallied, 38%? That really boosted the NAV.
38%, wow.
And they kept the quarterly distribution steady at around 50 cents per unit. Importantly, that's supported by a pretty robust $3.5 billion in cash and investments at the holding company level. So you put that together, the NAV jump, the strong cash position. It really suggests the market, after the call, kind of firmed up. It looked past the headline misses and focused on the underlying assets and liquidity.
Okay, so let's unpack that a bit more. Management clearly leaned into CVR Energy strength. They actually increased their stick, didn't they?
They did. And that move alone added something like $561 million to the NAV increase.
$561 million just from increasing the CVR stake. That's significant.
It is. And what's fascinating isn't just the past performance, but what they're saying about the future for the energy arm.
Like what?
Well, for starters, no scheduled refinery turnarounds for the rest of 2025 or 2026. That means smoother operations. Plus, they expect stronger diesel crack spreads.
Which means better profit margins on diesel.
Exactly. And they also mentioned CVR Energy paid down $90 million of its term loan, so better financial health too.
Okay, but there's this elephant in the room, right? The $548 million RINs liability. Can you just quickly explain what that is for listeners? It sounds complicated.
Yeah, it is a bit.
Yeah.
RINs are renewable identification numbers. Basically, credits tied to renewable fuel blending mandates in the U.S. Refiners either blend biofuels or buy these credits.
Okay.
This huge liability stems from ongoing fights over something called small refinery exemptions, basically, waivers from these rules. Management expressed hope, maybe with the new administration, that this could get resolved.
And if it does?
If it does, it potentially removes a massive financial overhang for CVR Energy. It could provide real clarity and be a huge positive.
Got it. So a big regulatory question mark. Also on CVR, there's a leadership change coming. The CEO, Dave Lamp, is retiring.
Right. At year end, Mark Patch is stepping up. He's an internal promotion coming from their fertilizer business, and he also ran midstream before.
So internal promotion, does that signal continuity, you think?
I think it does, yeah.
Yeah.
It suggests the core strategy for CVR Energy, which is such a key asset, will likely remain consistent. Stability is generally good there.
Okay, let's shift gears. Auto service. They're framing this as a turnaround, closing, 44 underperforming stores?
Yeah, 44 closed so far this year. But they're also planning to add 16 new ones, greenfield locations in faster-growing Sunbelt markets by the end of the year.
So pruning and planting, basically.
In much, it's a strategic shift. And you can see some early signs, maybe. After a 5% revenue decline in Q1, it improved, grew 1% in May and June. They expect it to accelerate more in July.
But it's costing them near term.
Oh, yeah. Higher labor costs, operating expenses.
Yeah.
Those are hitting EBITDA right now.
Yeah.
But the idea is these are investments for the long run. They're also working on boosting the average ticket price and renovating top stores.
Right, investing for future profit. Okay, let's talk pharma, VIVUS. They've started a big trial, 300 patients, for a drug called VI0106.
Yes, for pulmonary arterial hypertension, or PAH.
And they're calling this potentially disease modifying. That sounds significant. What does that actually mean?
It's potentially huge. Most current PAH treatments just manage symptoms. Patients often still get worse, needing lung transplants eventually. A disease-modifying drug could actually change the course of the illness.
Wow. Okay.
So for Icahn Enterprises, this isn't just another drug. If it works, it could be a game changer in how PAH is treated. Big market potential.
And when might we know more?
The first key data readout is expected in about 12 to 18 months, so sort of a mid to late 2026 timeframe. Definitely a longer-term catalyst to watch.
Okay. Let's switch to the investment funds. They were down slightly, about 0.5%.
Yeah, down 0.5%. But that was mainly due to hedges, broad market and refining hedges. If you strip those out, the underlying fund performance was actually positive 2%.
Ah, okay. So the hedges masked some underlying strength. Did they highlight specific investments?
They did. Mentioned AAP, that's American Electric Power, benefiting from AI data center demand, especially with operations in places like Texas, Indiana, Ohio, key data center hubs.
Interesting angle, AI driving utility demand.
Exactly. And they talked about SWX, Southwest Gas, closing its ROE cap, potential expansion of a FI TARK regulated pipeline.
FRK regulation meaning stable, predictable revenues.
Precisely. And SWX is also moving closer to fully separating its utility services division, Century, which could unlock value.
Got it. And Caesars?
Caesars, yeah. The digital business is flying, revenue up 24%, EBITDA up 100% in Q2. Management thinks that digital part is seriously undervalued right now.
Okay, so some specific bets paying off within the fund. Now, liquidity. You mentioned $3.5 billion at the holding company, plus more at the subsidiaries.
Right, another $1.1 billion in cash and revolver availability at the subs. They called it a significant war chest.
Is having that much cash always a good thing? Or does it mean they aren't finding enough places to deploy it right now?
That's the classic debate, isn't it? But in this environment, with higher rates and potential uncertainty, having that kind of firepower provides immense flexibility.
Right,
They can be patient, selective. And if we see some real market dislocations, maybe in a recession, they're positioned to act decisively. I see it more as preparedness.
Makes sense. Any quick updates on the other smaller segments, real estate, food packaging?
Yeah, quick rundown. Real estate. Successfully sold a country club they'd invested in for years. Classic Icahn playbook, right? Buy, improve, sell.
And redeploy the cash.
Exactly. They plan to put that capital into another club they bought recently in Pinehurst. Food packaging saw lower adjusted EBITDA, volume issues, inefficiencies, restructuring costs.
Yeah.
But they expect improvement by year end.
Okay. And home fashion, farmers.
Pretty flat, adjusted EBITDA-wise, compared to last year. So, active management happening across the board, even in the smaller pieces.
So, pulling it all together, what does this mean for you, the listener? The story here seems less about that headline EPS miss.
Definitely. It's much more about strategic moves, asset repositioning, management pulling different levers across this diverse portfolio.
And the market seems to agree, focusing on NAV growth and liquidity.
It appears so, yeah. That the unit price firmed up after the call suggests investors are valuing the underlying assets and the strategic direction, maybe more than just the quarterly earnings number.
And the total return reflects that recent shift too, trailing the industrials ETF longer term, but outperforming over the last month, some renewed interest perhaps.
Which brings up that key question, right? In this high yield world with rate pressures, how much can this kind of active management in a diversified structure really differentiate?
Good question.
They were showing cost discipline, narrowing that EBITDA loss, maintaining liquidity. That could be really crucial if things get choppy economically.
Okay, so looking ahead, you mentioned some catalysts. Can we recap those quickly?
4 main ones to watch. 1, Q3 update on auto service same-store sales, see if that turnaround is gaining traction.
Okay.
2, CVR Energy and those crack spreads, especially if diesel demand picks up. 3, that first interim data from the VIVUS PAH trial, VI0106, likely second half of 26.
The potential game changer.
Exactly. And 4th, any movement, SEC, courts, whatever, on those small refinery exemptions, the RINs issue.
Right.
If, say, 2 or more of those break positively,
Yeah.
that could really accelerate the shift they're making from just an activist fund to more of a diversified cash flow platform. And maybe, just maybe, start closing that big NAV discount.
Yes, the discount. You mentioned 40% earlier. Can you just unpack that? What does a 40% discount to NAV actually mean?
It means the stock market is valuing the entire company at only 60% of what its individual assets might be worth if sold off separately. 60 cents on the dollar.
Wow, why such a big gap?
It reflects skepticism, sometimes called the conglomerate discount. The market is essentially asking, can management really unlock all that value trapped in these different businesses?
Or is the complexity itself a drag? They're clearly trying to prove they can unlock it.
Right. A big challenge, but also a big opportunity if they succeed. Okay, that brings us nicely to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
All right, so given that huge 40% NAV discount we just talked about and the clear strategic shifts underway, here's a thought.
Okay, let's hear it.
Consider going long Icahn Enterprises LP common units, but maybe layer on a relative value component.
A relative value overlay, meaning?
Meaning at the same time, you could consider a short position, maybe in a basket of other holding companies, specifically ones that are highly levered, don't pay dividends, and crucially, lack a clear story for unlocking asset value.
Okay, so long IEP, short. Less focused holding companies. What's the rationale? The bet is that IEP's strong liquidity, that solid distribution, and their very active management selling clubs, fixing the auto shops, pushing that pharma drug, will drive a re-rating. That it will start to close that NAV discount.
And outperform the others.
Exactly. Outperform peers that are maybe less agile, less focused on actively creating value across their portfolio. It's basically a bet on IEP's execution, on their ability to deliver on those catalysts we discussed and prove their model works.
A conviction play on management pulling the right levers. Interesting, okay.
A conviction play on operational execution and smart capital deployment.
Yeah. All right. So as we wrap up this deep dive, the key takeaway really seems to be look beyond the headlines.
Absolutely. For a complex company like Icahn Enterprises, the underlying asset values, the strategic shifts, the liquidity that often tells a much fuller story than just the quarterly income statement.
Key things to remember. Management's focus on optimizing assets, that significant war chest of liquidity, and the potential impact of those longer-term catalysts.
Especially that PAH trial and the ever-present RINs issue. Those could be major needle movers down the line.
Well, thank you for joining us for this exploration of Icahn Enterprises Q2 call. We really hope this analysis gave you some valuable insights. What stood out most to you? Are you seeing similar dynamics elsewhere?
And just a reminder, of course, this discussion was for informational purposes only. It is definitely not financial advice.
We'll be back soon with another deep dive into the numbers that matter.